I'm going to talk about Australian dollar and the US dollar in three terms. First of all, I'm going to talk about inflation. By looking at the graph, we can see the inflation rate in Australia at July in 2016 is 1.0%, while in the US is 0.8%. So Australia has a higher inflation rate than America. As a result, the products in Australia are more expensive. This will have a terms of effect. First of all, residents in Australia, when they buy products, because the price in Australia is very expensive, so they will think about to buy from other countries, which increase the import of Australia. This will make the supply of the AUD going up. And secondary, if people from other countries are planning to buy products from Australia, but because of the inflation, the price in Australia is extremely high, so they will buy from other places rather than Australia, which decrease the export of Australia, and the demand of the AUD will going down. As a result, the exchange rate of Australian dollar will go down. Secondly, I'm going to talk about interest rate. According to the Reserve Bank of Australia, the interest rate in Australia is 1.5% at 2016. For America, the interest rate is 0.5%. So Australia has a higher interest rate than the US. On hand, for other countries over the world, people are likely to save their money in international banks with higher interest rates, so they will gain more money. So they will save their money in Australian banks because the interest rate is higher rather than American banks. So which encourages the capital inflow and increasing the demand of the AUD. On the other hand, the residents in Australia would save their money in their own banks because the interest rate is higher than other countries, which discourages the capital outflow, and the supply of the AUD will decrease. As a result, the exchange rate of Australia will go up. Finally, I'm going to talk about GDP growth rate. By the graph, we can see the GDP growth rate in Australia is 2.5%, while in America is 2.2%. So Australia has a higher GDP growth rate than America. One effect of higher levels of economic growth is an increased demand for imports. This will increase the supply of the AUD and shift the supply curve to the right. And higher levels of economic growth increase the level of overseas investments and therefore more demand for AUD. At this time, the supply and the demand for AUD both go up, so the exchange rate stays the same. But let me talk about this issue on the opposite way. A higher GDP growth relatively means a stronger economy, which means there are more industries and the producers produce more products as people consume. So there is an increase in exports, and there are more people are hired to work, which decrease the unemployment rate in Australia. So I think the demand will go up, so AUD will appreciate against the USD. So after all, in my opinion, I predict that the AUD will appreciate against USD in the next 3 to 6 months.
The value of the Japanese yen in comparison to the American dollar has increased over the past 6 months, increasing from 0.0088 on the 15th of March to 0.098 on September 15th. It raised to a peak of just above 100 on August 17th. The currency held some balance and stability between the months of April to June and then between July to September, but it was in the month of June that the yen rocketed from 0.0091 to 0.0098. It's not preferable for the government to have an appreciating yen, the Bank of Japan has been aiming to boost their island nation's inflation to 2%. And everyone recognizes that an appreciated currency means more appreciated exports, more expensive exports, and cheaper imports, which negatively affect aggregate demand and thus stifling inflation. With exports in 2015 being recorded at forming 17.8% of the nation's GDP, the appreciation of the yen is a massive detriment to the nation's struggling inflation rate. While the United States has a reported inflation rate of 1.1%, which has been stable if not trending upwards, the Japanese have faced a downward inflationary trend, dropping from a positive 0.3% rate in February to 0.4% rate announced this July. The Japanese yen has frequently been referred to as a safe haven currency. It is well reported by Botman, Philo, and Lamb in 2013 that in times of foreign economic turmoil, that the yen has appreciated rapidly in value as traders seek an avenue of risk aversion. They showed that on these risk-averse episodes, only the yen and the Swiss franc appreciated. Elements of safe haven currencies are shown through the host nation's lower interest rates, large liquid financial markets, and strong net foreign asset positions. The Bank of Japan's interest rates have gone to a negative 0.1% recently, and they have been for a long time being held at 0%. This is in stark contrast to the US Federal Reserve, which last December raised from 0.25% to 0.5%. Furthermore, Japan holds a strong financial position on foreign currencies because of long past periods of carry trade occurrence, as well as the government actively selling yen for an improved export conditions. These financial conditions create an ample escape for foreign exchange investors to translate their currencies into yen, which is seen during the July episode of the Brexit announcement. So over here we see the VIX, which is the volatility index, which measures implied volatility for a basket of put and call options, in this case on the Standard & Poor's 500. And so typically it's a relationship between when stocks decline and it goes down when stocks advance. So during the Brexit, when the pound value dropped to a 31-year low, it spiked in July. However, the yen, during that same period of July, it rose the most. However, while the yen may be a safe haven currency, the Carville and Philo and Botman concluded that market changes resulted more from derivative changes than rather actual capital transfers. And so that doesn't exactly mean a better foreign direct investment levels for Japan. While in times of economic stability, carry trading with the yen has provided to foreign trading positions a source of revenue. A carry trade is when the return cost received from holding an asset, so that in the case of the foreign exchange markets, a high-yielding currency is financed with a lower-yielding currency borrowed, securing the difference as a profit. And so it's because of this that traders are interested in secure non-fluctuating economies with large pools of currency, as the lack of appreciation means continued returns and large currency pool divides the carry trade risk to minimum levels. Historically, this occurred in the 1990s during Japan's lost decade, where though the Bank of Japan's monetary reaction to a speculation-fueled domestic real estate bubble, deeming it unsustainable, and in turn raised interest rates. The Japan stock market crashed as a result, and so they experienced a stopped economic growth and deflation for 10 years, or close to it. And so in the mid-90s, the Japanese bank dropped interest rates close to zero, while other nations held very high, or relatively, interest rates. And so for the period of 1990 to 1998, foreign traders went short on the yen and long on anything considered a dollar. Recently, traders have been reducing their frequency of contemporary carry trades, meaning a reduced borrowing and selling of the yen, especially in light of such post-Brexit financial uncertainty. However, only this Wednesday did the Bank of Japan announce to increase the yields of its 10-year bank bonds from negative to 0%, and so this fiscal stimulus policy to buy up bonds until this target is reached will increase the supply of yen and may counterbalance any contemporary reductions to trading against the yen. However, we doubt that this policy will stop current currency trends for the yen to appreciate.